Hello, everyone. Good morning. Thank you for joining us today for the Credit Modernization webinar, Preparing for the Next Generation of Lending. Before we get started, a few quick housekeeping rules. This session is being recorded. You will receive a copy right after the webinar. We have reserved time at the end for questions. Please submit your questions using Zoom Q&A panel. Polls will pop up throughout the session. Please take a moment to respond. This session runs about 60 minutes in total. We have designed to move very quickly, so stay with us and we will do our best to give you 5 minutes back to your calendar before your next meeting. My name is Sunita Nair. I'm from Tavant. I've been at Tavant for about 5 years now. Prior to Tavant, I was at Fannie Mae for roughly 15 years, and I was a part of the credit modernization, managing the bureau relationships as well as the CRAs. And today, I am pleased to be joined by two exceptional industry leaders. Carrie Doyle from Equifax brings in extensive expertise in mortgage technology, credit data, and lender transformation. Anthony Hutchinson from VantageScore has been in the forefront of modern credit scoring innovation, policy discussions, and shaping the future of mortgage lending. Today's discussion is especially very timely. As you all know, the mortgage industry is entering one of its most significant credit transformation in decades. Evolving GSE requirements, newer credit scoring model, advances in AI, and increasing pressure to improve borrower experiences while controlling risk are asking lenders today to modernize not only their technology, but their entire credit decisioning strategy. As you can see, it's a tall order. Me and the panel members are going to try our best today to help you break that down into areas that you can quickly tackle. So during the next hour, we will discuss why credit modernization is accelerating, how VantageScore 4.0 can support growth while managing risk, what lenders should do today to prepare, how AI is changing the lending operation, and how modern credit can be enabled through across the LOS and servicing platform. So without further delay, let's go ahead and get started. I'm going to get started with Carrie. Carrie, go ahead and introduce yourself, and then let's touch on why credit modernization is accelerating, what your experience has been working with tons of lenders and prospects in this industry. So over to you, Carrie.
Hey, thanks, Sunita. Thanks for having me here. Just a brief intro in my role here at Equifax. I work with our strategic connector partners, and I've been doing that for the past decade, where I sit in between our data and our lender users and our third-party technology partners. And it's really allowed me to work with companies such as Tavant and Vantage, as well as our lender community. And you're right. When you think about the changing environment that we're in, it's the craziest I've seen in my years in this business. You know, this convergence of technology, regulation, and market demands really creates an exciting opportunity to move this industry forward. You know, on one side, you've got external catalysts like FHA's modernization efforts, the shift towards the next gen credit models, and ongoing regulatory evolution. At the same time, we've got digital lending and changing consumer expectations that are all forcing speed and simplicity to the forefront. Underneath it all, what's really making this acceleration possible is better data availability and alternative data attributes. Lenders finally have the tools to get a complete and modern picture of a borrower, enabling them to meet the ultimate market mandate, helping consumers gain access to credit by increasing approval rates without taking on added risk and losses. Modernization is really about giving lenders the optionality in underwriting needed to serve more borrowers effectively.
That's great. So what I'm hearing, Carrie, is modernization isn't simply about replacing one score with another. It's giving lenders more complete information to make smarter lending decisions. I think that's the point you're driving here. Truly, truly appreciate it. I'll come back to you with more questions here, but I'm going to move to Anthony, also known as Tony. From VantageScore perspective, what are you hearing from the lenders and the customers that you work with today?
Yeah.
And Anthony, go ahead and introduce yourself, please. Sorry.
I will do. Thank you, Sunita. I am Anthony Hutchinson, but you guys can call me Tony. There are only two people in my life who call me Anthony, and neither of them call me that for good reasons. That would be my mother and my wife, and I usually get the Anthony when I've done something wrong. So I'm hoping that as we start this conversation, I've not done anything wrong. So I'll ask that all of you guys refer to me as Tony. I too have had a long career in mortgages. I've spent 10 years apiece at both Fannie Mae and Freddie Mac. So I've kind of taken the grand journey around housing finance, specifically on the secondary mortgage market. Uh, I was brought into VantageScore specifically to help the organization move into the conventional conforming space. So help them with this mandate that Kerry mentioned by the regulator to modernize the credit scoring system. And once that occurred, then it was time to begin a level of education of both the secondary mortgage market, Fannie Mae and Freddie Mac, and the folks in the primary mortgage space, our lenders out there, and all those organizations and entities that support the consumer from origination all the way through delivery of a mortgage into the secondary mortgage market. Now, Sunita, you asked a question about what makes VantageScore different, what sets us apart. Well, there are a number of things that set us apart. And I'm going to ask that everyone that's participating here actually do a little homework and really get to know us. There are going to be other things that I'm going to ask you to do towards the end of my portion of the conversation, so that you get a better familiarity with not just the company, but with the product that we put out there. But the big three that we bring to the table are we increase the population of people who lenders can reach. We score 33 million more consumers in the marketplace. Kerry mentioned modernization and a complete picture of the consumer. Because we have more data that allows us to develop a complete picture of the consumer, we're not just doing that with consumers who already have credit. Anybody who has touched credit or has access to some sort of financial payments, we're now able to see that and score that so that they have the opportunity to determine if they want to move into the credit space. I'll caveat those 33 million by saying not all of them are credit worthy. Some of them are going to have very low credit. Some of them, surprisingly, have very high credit. But the key is these are folks who to this point had no credit and were extremely invisible to the system, which meant that they were held kind of hostage to a system that was going to charge them more because they were invisible or not give them access to credit. Now, because they have a score, some of them are going to be able to take advantage of higher scores and the fact that they've made payments on different data that is being considered, and they're going to get favorable pricing. The others now can make a decision. Do I move forward knowing that I'm going to have to pay a higher rate, or do I work on my credit so I can get a lower rate? But the bottom line is the decision now resides with them. And I will just throw this out there, the 33 million more people only gets us to about 92% of the scorable population that's out there. Our goal is to get to everybody that's out there. We'd like to provide that to everyone. The other thing that we bring, and I touched on this a little bit, is, and Kerry mentioned this, there's a plethora of data out there, and Equifax has a lot of that. So we're able to mine all of that information. So not just the traditional attributes that we use to score people, but alternative information like rental payments, telecommunications payments, utility payments. All of this for the new consumer really focuses on what they bring to the marketplace. I talk to people a lot of times that the new consumer is more concerned about making their payment on their cell phone than they are on anything else. That cell phone is their lifeline. So making sure that they have utilities that can support the cell phone, like electricity, keeping their telecom up to speed, up to date. That is very important. And most of them need a place to stay. So rental data plays a big role in there. So bringing more data in is extremely important. And then the other thing that really sets us apart is when you take a look at the scores across the three credit reporting bureaus, because VantageScore is owned by all three. Now we're operated independently, so we handle the creation of the algorithm on our own. But because we're owned by the three credit reporting bureaus, that gives us access to a large library of information, which allows us to really enhance our algorithm that is in the marketplace. And because of that, we're able to make sure that we're pulling nearly the exact amount of information across all three. That means that when you get a VantageScore from one bureau, when you pull it from Equifax, it's going to be very similar, if not right on top of the other two. That is very important to us. And I mentioned all of that, but I don't want you to take any of that as word from us. VantageScore has been in the marketplace since 2006. So we've been around for a long time. In fact, this is our 20th anniversary this year, founded on Valentine's Day in 2006. So we've had models in the marketplace. We're just new to the mortgage market. And when our score was compared to the existing score in the marketplace, a lot of independent third parties came out, did an analysis, and determined that VantageScore 4.0 was much better than the classic score that was in the marketplace. And you see this from a number of investment houses, as well as some additional third-party research out there in terms of prosperity now. So all the metrics from delinquency to capture of early prepayments to just the additional people that would have been identified as being problems during one of the last financial crises. All of that occurred with the new score that was in the marketplace. And I'll stop right here and then we'll move on because I'm sure that we'll get back to some other slides a little bit later. I don't want to take up all of the time. But one key point or one key takeaway is the current consumer is a new generation borrower in the marketplace. As I was mentioning, they look at credit a lot differently than I did when I came out of college in the late 80s. So the scores that were out there, for me, don't accurately capture the current consumer. The utilization of trended data, the utilization of traditional attributes plus alternative payment data, all of that plays into allowing us to score more folks. And a lot of those folks are thin filed, but they're very active in that utility payment, rental payment, and some of those other alternative payment methods. And those are the people that we're going to want to focus on as things move forward. With that, that's what separates us. There's a plethora of other things I could talk to. I don't want to take up all of the time, but I'll let you guys continue the conversation. I'll probably come back to my slides a little bit later.
Thank you, Tony. That's a perfect segue to a couple of things I wanted to ask. If I were a lender and I'm thinking about ingesting VantageScore 4.0 into my workflow today, but they're still asking very simple questions such as, why should I care? How is this trended data enabling me to kind of, qualify more borrowers? Am I doing it in a safe and sound manner? What does the broader scorable population looks like, right? So the business outcome for majority of the lenders are going to be better segmentation, portfolio growth, reduced false decline, right? So can you explain a little bit? I do know you touched on this, but I would like to go back and reinforce. It's a very simple question. As a lender, why should I care? What are the few top things that I should consider as I think about a better borrower experience and qualifying more borrowers in a very safe and sound credit environment?
I think the key that people need to take away is that you're going to reach more people, and that is going to be a great positive to your bottom line. And you're not just reaching more people, you're reaching more people that are going to be similar to the folks that going forward you're going to have to service. So understanding them, understanding how they come to the market and how they present in credit is not going to just be valuable right now to expand your market opportunity, but it actually leans into who you are going to be dealing with in the future. We talk a lot about a gig economy that's out there. So people are bringing income in this different way. People are not just bringing income in differently. They're spending money differently. There are different priorities for them, and that's reflected in the attributes that we pick up related to credit. So having a better understanding of that is going to be beneficial. The other thing that's extremely beneficial is more predictive models mean that throughout the ecosystem, pricing and execution are going to be better. Because pricing and execution are going to be better, that means there's going to be more opportunity for your bottom line to expand, but it's also going to be a better experience for the consumer, potentially reducing cost all the way down to them. And that's something that is absolutely important. Right now, affordability in the marketplace is something that you hear about. Just for full disclosure, in my role as head of public affairs here at VantageScore, I don't just handle the industry, but I also handle the government, specifically the federal government. One of the things you hear in Washington, D.C. on Capitol Hill is the idea that things have become unaffordable. And the number one thing on that list is housing. Everyone, Democrats and Republicans, talk about how they can improve consumers' ability to be able to afford a home, how they can improve consumers' ability to be able to qualify for a home, and how they can make that experience something that is less daunting than what we saw coming out of the Great Recession, where people were in homes, lost homes, and now there's a perception that I can't get a house. These new credit models are, again, taking a look at information in a way that understands the consumer, is able to adjust for the new way that the consumer is acting in the marketplace, determine if they're creditworthy. And because of that, and because of the excessive amount of information we now have access to, and Carrie mentioned this, we have a large amount of information now on the consumer. That allows everyone in the ecosystem, in the financial ecosystem, to be able to accurately make an assessment. That accuracy improves pricing. That accuracy improves execution. That accuracy expands the marketplace. So all the way down the line, from origination through moving the product out into the secondary mortgage market, in this instance, you're going to have a better execution that is going to save money for you, that is going to save money for the consumer, and that is going to expand your opportunity in the marketplace. That is the great thing that comes of this.
Excellent, excellent. Thank you, Tony. That is truly, truly exciting. And I like the way you explained it. And again, affordability, better borrower experience being in the front and center of it. I'm going to come back to you with more questions, but I would like to move to Carrie now. And Carrie, here is something that I get to hear from our lenders all the time. What role does the credit bureau play as lenders begin adopting the newer models? Like what kind of implementation consideration or validations or readiness does the bureaus really kind of emphasize as people think about adopting the newer models? I would love to hear your viewpoint on this.
Well, I really think this is key, partnership. You know, we think of partners that I'm on the phone with here now in this webinar and partnering with our mortgage lenders. It's not just plugging in the new model and moving on. It's really engaging with your technology partners and make sure you're operationally ready for these new score models. That's really, really important. Lenders need to build agility into their current setup to use those new credit models. And your bureaus and your CRAs can help you make sure your data is clean, help you leverage APIs, and ultimately getting your system ready and integration readiness to ensure your systems and workflows can seamlessly connect and adopt the new tools really reduces that operational friction as well.
Got it. That's excellent. And this question is both to you and Tony as well. What advice would you give to the lenders and customers who are just beginning this journey of adopting newer scoring model? And they might be confused or they might be like at a starting point. What would you give them as a key takeaway and advice that they can follow and make their journey a little bit less cumbersome? Where do they start?
Well, I was just going to say again, work with your partners. Start testing and piloting the new VantageScore scoring model today. Work with your tech partners and your CRAs. Use the next 6 months to run them parallel with your actual operational workflow. And then that way you can catch any friction early. You can refine your process with your vendors and make sure you've got a really seamless, low risk transition. Tony?
Okay.
Yeah, no, I agree with that. I mentioned it earlier, this idea of homework. There's a lot of it to be done. Carrie outlined uh, perfectly what you need to do in order to get started. One of the things I would say is, aside from reaching out to Equifax, because they're a great partner and they can get you started, if you really want to understand VantageScore, you can go to VantageScore.com. We have a page that is focused specifically on tools that you can utilize. A product called Risk Ratio will allow you to take a look at how a VantageScore performs over time, and you can do that by product. You can see how it performs for a credit card, auto loan, personal loan, and mortgage. That would be a great place to go. You also have a product called Inclusion 360, which allows you to see who are the newly scored consumers in your footprint. So be it in your county, in your state, in a congressional district, whatever areas around you, you can take a look at that. We also have a monthly publication that talks about the credit health of the consumer called Credit Gauge, where you can sign up for uh, this monthly newsletter that comes out that gives you insight into what's impacting the consumer. And then finally, a product that you can order through Equifax and carry directly is called Market Gain, where we will take your actual footprint and then share with you what the opportunity within that looks like for the newly scored. So there are just a number of different things that you can use to get familiar with the score, with VantageScore itself, with VantageScore 4.0. We also have a mortgage integration page. So it's all homework, really getting out there, understanding how do I bring it in? Why is it important? Who else is seeing these 33 million more consumers? How do they perform? What are the other reports that have been done? I showed you a couple of those. We've got links to those so that you aren't just taking our word for it. You're actually seeing the work that's been done, understanding why that work was done, and seeing how it will play out in actuality. So when you do bring the scores in, you have an understanding of how performance will occur. So I would say that that is what you really, truly want to do. Work with your credit reporting bureau, Equifax, to make sure that you can ingest the score, that you see it parallel for a period of time. Make sure your systems work. Make sure you can not just bring it in, but push it out to where it needs to go, be that the GSEs. But then on the other side of that, understanding how the score actually operates, because the new scores, because they include trended data, are not going to operate and have similar scores to the classic score in the marketplace. I think we'll touch on that in a minute, but that's a significant difference, and you want to know that performance, and you want to see you want to develop the correlation between the new one and the old one, so you have a starting point, you know where things are going, and you'll be comfortable in your operations later.
Got it. And that's a perfect segue, Tony, to the multiple scoring model support, which talks about the traditional scoring model versus incorporating trended data. And a part two of the question I'm going to address or ask you here is also talk a little bit about this AI governance and infusing AI into the credit modernization world, and how has that changed the governance around monitoring credit, right? So this is a big white elephant in the room. Everybody's talking about AI. People are still very confused about what does that mean from a credit modernization perspective. Would love your point of view and as well as Carrie's point of view. How is that playing into the entire governance, and what is it that you're hearing as you sit in DC talking to the government dignitaries as well as the lending community? What are you hearing around AI and model governance versus traditional versus trended data?
So it's very interesting right now in Washington, D.C. when it comes to things such as data privacy, data integrity, security. The place that is just beginning, that is very fledgling in terms of the way folks are beginning to think and talk about it, is artificial intelligence. All of those other topics play into it, but artificial intelligence and how guardrails are going to be placed around it is just at the beginning. I would recommend that everybody that is on this call, I'm sure you're a member of a trade association, specifically in mortgage, that focuses that is now beginning to focus on artificial intelligence. I would encourage you to monitor the work that they're doing for a number of reasons. One, the federal government, like I said, is just beginning, and the frameworks that they're putting out there are extremely broad. So they're in a period of discovery. So you're right on the same page and pace with the federal government in terms of this. Where you're seeing a lot of action occur is at the state association, at the state level. A lot of state governments are trying right now to figure out how to put guardrails around AI. But again, they're focused on data integrity, data privacy, and not really how the machine uh, is utilized in the manufacturing of things such as algorithms for credit. But they're going to get there. And the reason I
Mhm.
say you want to monitor that is because you want to know where they're going to go. And the trade associations and organizations like Equifax and ours and VantageScore, we're going to be out there monitoring it and trying to help them logically put guardrails in place. But what I would tell you is right now, there's a lot of fog. People are trying to figure it out. So the best way to protect yourselves is to understand what is that overall conversation talking about? Where is it focused? And right now, they're just beginning to set the foundation. So I would recommend getting out there. You don't have to dig into it deep. You've got people who are nerds like me who do that. And there are a number of us and a number of different trade associations out there. And we'll share not only what we're hearing, but what we think is going to be the direction so that you can have a better understanding of where you need to position your organization. But right now is a good time to pay attention because it's just really starting out.
Excellent. Excellent. Thank you, Tony. That's very, very helpful. Love it. And also, we are talking so much about model governance lately. You know, AI governance is in the front and center of every company we talk to. The first question that comes up in people's mind is, what are you doing around the governance? How do we know these models are safe and secure, and you've taken all the standards and regulatory requirements into consideration, right? So what I'm hearing you say, Tony, is that talk to the experts, look at what's happening in the industry, reach out to people who are doing this day in and day out. But it is important to understand the governance that is getting built into all these different models and how AI is getting infused into the workflow. So there is no silver bullet or an answer, a straightforward answer to that. What I'm hearing over and over again is it is evolving as we all speak and as we all kind of look through this together. But the more important thing here is to reach out to the right folks who might have better knowledge around governance and model and how this gets infused into your workflow. Is that right? That's the right way to think about it, is what I'm hearing you say,
No, that
Tony.
is, and I would say that's the right way to think about it related to artificial intelligence and how it's going to begin to impact the system. But what I would tell you is, and Carrie, feel free to take it further. There have already been rules and regulations put in place related to how organizations have to, one, gather, credit information, house it, display it, utilize it, craft algorithms. And this is before we've had all of the new AI uh, topics and issues come into play. So there have been rules for a while, fair credit reporting, et cetera. And the one thing I will tell you is that every one of the bureaus and all participants in the marketplace have to adhere to those existing rules in order to be able to participate in the marketplace. So the fact that you're getting data from an Equifax, they're already following those rules, and the fact that you're getting a VantageScore, we're already following those rules. The new frontier is going to be, how do you utilize this new technology called artificial intelligence that effectively is going to allow you to mine information quicker, faster than any humans ever could, or faster than any of the machine learning techniques that we've had in the past. And that is going to require a different set of rules and standards.
Yeah, I'll agree with you, Tony. I mean, there's no doubt that AI has increased productivity and innovation. At Equifax, and you mentioned the rules and regulations that we have to abide by with our data. You need to make sure, and we ensure that we use AI for not just product innovation and development, but that we're transparent, we're fair, and it's explainable. I mean, Tony's the data nerd. I'm not. But if we can explain to end users how we use it in a secure manner, it's a game changer. And, with that, we can harness the power of AI and advanced data science to expand the predictiveness of our data. That's the important thing. For example, we'll just use that. We've got so many products at Equifax that through that innovation with AI, again, let's talk about how we can then help leverage those 33 million people into scorable credit bands. All done, not 100%, but done with the help of AI. We were able to go deeper, better.
Excellent. It's now I'm going to get into a topic of interest, enabling modern credit across LOS and servicing. So we're going to talk about what this platform looks like, right? When we talk about credit modernization, we should think about credit as a single decision that happens as a point of origination. But the opportunity is much bigger. The modern credit view that you're looking at on the screen right now is about creating a connected ecosystem across the entire lending life cycle, from application to underwriting to servicing to portfolio management. Let's start with data. If you start looking at the left side of this picture, everything begins with data. Like Tony and Carrie emphasized, they are getting a lot of data from all the three bureaus today at VantageScore. And traditionally, we've relied heavily on credit bureau data. Today, lenders also have access to much broader set of data and information on income, employment, asset, liability, property valuation, banking transaction, alternate data, and third-party sources. That's a lot of words, but you know what I'm saying here is we have access to a much broader set of data. But simply having more data doesn't create better decisions. We all know that. The real question is, how do we bring the data together, validate it, make it actionable at the right moment, and make sure the actionable decision are being done in a safe and sound manner, leveraging the technology that's available to us today. So the modern credit resides inside of the LOS system. This brings us into the loan origination system, from application, data capture through underwriting. Disclosure, closing, booking, credit intelligence need to be embedded directly into the workflow. We don't want employees jumping between systems or manually interpreting the information that technology can evaluate in seconds. That's where the modern technology comes into play. The goal is to bring data, credit model, rules, AI, automation directly into your loan origination system workflow so we can make decision faster while maintaining the transparency, explainability, and appropriate human oversight. Human in the loop, when you think about credit, is never go out of the picture. It is still a part of the overall workflow and process flow that we put together. But it is extremely important to kind of enable the modern enablers by bringing automation directly into your workflow. The intelligence layer is in the middle. The most important part of the picture may be in the middle here. This is where the data orchestration, the AI, the automation, the APIs connection, and origination and servicing happens. Instead of building a point-to-point integration for every system, what we do is we create an orchestration layer that can ingest information, normalize it, apply intelligence, trigger workflow, and distribute decisions across the lending ecosystem. And this is also where the middle layer is where the workflow automation becomes important. When the data tells us something has changed, the system should enable and be able to determine the next best action, whether that's requesting additional documentation, routing an inspection, triggering a review, or communicating with the borrower. So it's very important that the middle layer is where the entire data orchestration and automation comes into play. This looks a little complicated in first sense, but your technology partners and your IT services partners can definitely help you enable that orchestration layer and also to bring in the modern technology and infuse that as a part of your overall workflow. Servicing becomes a big part of credit strategy. Historically, origination and servicing have always operated at two separate worlds. You have your origination, then you have your servicing. Modern credit changes that. Servicing generates incredible valuable information regarding your payment behavior, delinquencies, modification, collection activities, customer engagement. That information is so valuable and it should create a feedback loop into your credit strategy. Instead of making credit decision once and essentially freezing it, that the view of the customer, we can continuously understand how the customer is evolving, how the risk is evolving. So it's very important that the credit strategy and feedback loop is tied, coupled together, and you need to consistently have the information about your consumers as they evolve and look at the risk and how the risk is evolving, right? What this does is this enables rescoring, early warning indicators, proactive customer engagement, and better portfolio management. This is all about ensuring that the credit worthiness of the borrower is consistently evolving. The programs that you offer today to repair credits, to enable consumers for better loans, better interest rate, all of that is a big part of your business outcome and ROI. And by consistently incorporating the feedback loop into your credit strategy, you're able to look at the various programs that your technology can enable for your end customer. At the same time, how do you serve your borrowers better? How do you alert them of different programs that are available to kind of improve their credit worthiness? It should definitely bring in that ROI into the mix. This is not just about technology. It's also about how do you make sure your credit strategy is enabling a better experience for your borrower and making sure you're providing them the continuous education that is required to stay healthy, have better credit scores, and continuously evolve for better programs. So from transactional credit to a continuous credit intelligence is really where the transformation begins. We move from a point in time credit decision to a continuous credit intelligence throughout your customer life cycle. Origination informs servicing, servicing informs portfolio strategy, and portfolio performance improves all your credit decisioning, the future credit decisioning. And the data continuously moves across the ecosystem through APIs and orchestration. So the point I'm trying to dive here is that you can enable modern credit across LOS and servicing by incorporating some of the strategy I went over very early on into both your technology and business roadmap. What does the business ultimately get out of this modern credit world? It is creating measurable business outcome. What that means is a better risk management, higher portfolio quality, greater operational efficiencies, faster cycle times, stronger compliance, and a better consumer experience. I know this all looks like a lot to consume, but the point here I'm trying to dive is you have an opportunity to connect various portion of your ecosystem and move more intelligently across origination all the way to portfolio management as well as retention, while enabling a better borrower experience and better credit programs for your end consumer. Technology helps you drive that force much faster, but technology alone doesn't solve for what we need to give our end consumer and borrowers back. So it's very important to have a credit strategy and marry the credit strategy with your technology roadmap and the business roadmap, and consistently work with the bureaus, the CRAs, and people that matter that can help you deliver a better outcome for your borrower experience. So I would like to leave you all with a thought. Enabling modern credit across LOS and servicing is all about continuous credit strategy built into your portfolio management and not freezing credit in time for your consumers. And how do you consistently create that loop, the feedback loop across all entire workflow end to end, eventually ending up with a better borrower experience. So that's what I wanted to cover. If you want to learn more about what is it we do to enable modern credit, feel free to reach out to any one of us. You can reach out to Carrie or Tony or myself. I can definitely talk about what Tavant does in this space and kind of bring you up to speed on some of our use cases and business challenges that we solve for with our lenders. But I would definitely like to leave you with this thought that modern credit across LOS and servicing is more about how do you have a continuous feedback loop and journey end to end. With that, I would turn now to any poll questions or Q&A so that we can just spend the next 10 minutes going over your Q&A, and then we can give you guys maybe 5-10 minutes back on your calendar if possible. Thank you so much for joining us today, and I would now focus on the Q&A.
Yeah, so I see a question out there, and I can address this really quickly. It was asked. We mentioned that the current credit scoring models, specifically VantageScore 4.0, utilizes trended data. The question was, so classic FICO that's used for mortgage does not. That is correct. Classic FICO does not utilize trended data. In fact, trended data really began hitting the marketplace in 2017. VantageScore pioneered that in the marketplace, and we've been using that product for credit card, auto loan, and personal loan. So organizations out there that utilize us have already been utilizing trended data. The one place that hadn't been using trended data was the mortgage market. Based on what was being utilized by the financial services market in 2017, 2018, 2019, there was a movement in Congress to update the mortgage market so that they too could follow suit and utilize trended data. That the legislation was promulgated by two senators, Senator Tim Scott Republican from South Carolina, and Senator Mark Warner, a Democrat from Virginia. They both felt that it was necessary to modernize credit scoring in the mortgage market, and more importantly, to ensure that my two alma maters, Fannie Mae and Freddie Mac, were able to operate safe and soundly and utilize more modern technology so that they could better understand the consumer in the marketplace. So fast forward from 2017, when they introduced legislation, it was signed into law in 2018 by then President Trump. And then the next two administrations, the Biden administration and the current Trump administration, effectively worked to make sure that the product was put in place. They worked very hard to make sure that the new score was understood, that it would fit in the GSE systems, and now they put rules in place for utilization, and now they're rolling it out. So what you're seeing is this movement away from a score that just focuses on the consumer at a point in time and that looks at them over a period of time. So the trended piece means that we're not just looking at Tony Hutchinson today at 12/16 on August 11th. We're taking a look at Tony Hutchinson over the last 24 months to determine how I have utilized my credit. And that could be I had very poor credit, and over time I was making good, better credit decisions, and I'm trending in an upward trajectory, meaning I'm moving to a better score. It could mean that I was deemed very high in credit, but have run into some issues and things have been going down. Or I'm just steady over time. But the credit evaluator now has a tool that gives them more insight into the consumer. Are they getting better? Are they getting worse? Are they staying fine? Did they have an obstacle that they got over? That they were doing fine, ran into an obstacle, and then got themselves back. All of that contributes to a better picture of the consumer. So, yes, the new credit scoring models are using trended data. The old classic model in the marketplace does not.
Carrie, would you like to take the next question and then I'll go after you?
Sure. Well, I mean, the questions are more towards FICO, or in Vantage. But what I can say is when we think about the models, we also need to think of the alternative data that's out there with the trended data to help score those 33 million people that Tony talked about before. I almost think 33 is the magic number that we should even play in the Powerball. But the traditional models often require at least 6 months recent activity on standard trade lines, and that leaves those 33 million people credit invisible. When you incorporate those non-traditional payments and the multi-year trajectory data, you're putting previously unscorable credit-worthy people into different credit bands without compromising safety or credit soundness. That's really important to think about with the new models.
And I would say the new models are actually, because I saw another comment about some of the seasoned scores for folks under the old credit scores being scored higher. Well, the new scores, because they're bringing in more data, are more accurate than the older scores. So, yes, you may see that for seasoned consumers that their scores could come down. Mainly because you're not looking at them at a point in time. You're looking at them over a 24-month period. And you're bringing in more variables, more attributes to really evaluate the consumer. That change that you've noticed means that the algorithms are actually working. There'll be some people that go up, absolutely. But there will be some people that come down. And what the person who was asking that question or making that observation has found is exactly what we see. The folks on the tails are really being evaluated very, very well. The folks in the middle, yes, they're making some gains. But what we find from our data is we see people that are prime, some of those now being evaluated do move to super prime. We do see super prime coming back. We do see people that were invisible now becoming visible and being eligible. But that's what the new model's about. And the more data that's introduced, that's the benefit. And we want to see that.
Thank you, Tony. I'll take the next question here. How is Tavant approaching agentic AI in credit decisioning differently from the traditional automation tool? This is a really good one for a technology company like us. Traditionally, automation is largely a rule-based. You define the workflow, you define the rules, the system executes them. Agentic AI, on the other hand, takes us a step further. At Tavant, we look at agentic AI as an intelligent orchestration layer around the credit decisioning. It can understand the context of the borrower, the loan, and bring together information from multiple sources, identify what is missing, determine the next best action, coordinate the different steps that is required to move the loan forward. The important distinction here is we are not suggesting AI should simply make an unexplained credit decisioning. In lending, decision needs to remain governed, explainable, and auditable. This is extremely important. I'm going to repeat that again. Decision needs to remain governed, explainable, and auditable. Our approach at Tavant is to use AI to augment the existing credit model and the decision engine, helping lenders automate the work surrounding the decision and intelligence, and manage the exceptions. So think about the agents as helping you manage the exceptions and moving through the workflow faster. So instead of an underwriter or processor navigating the five system, reviewing multiple documents, figuring out what to do next, an AI agent can bring the information together, identify the exception, and recommend the next best action and help you route it appropriately. The goal here is to move task automation to an intelligent decision orchestration. Human in the loop will remain in control where the regulatory judgment oversight is required. So that is the distinction. And everything you do around approaching agentic AI, again, I will repeat it, is it has to remain governed, explainable, and auditable. So that's the way at Tavant we approach when we think about agentic AI in credit decisioning. Okay. Any other question, Tony or Carrie, you want to take? Otherwise, I'll also address one last question here after that.
I haven't seen any additional.
Okay.
Yep.
All right.
Go
So
for
there
it,
is one
Sunita.
other question. Thank you so much, Carrie. There's one other question. What's the biggest technical hurdle lenders face when trying to integrate AI-driven decisioning into legacy LOS platform? I would say the biggest hurdle is data and integration, not necessarily AI itself. Most lenders have legacy years of business rules, custom fields, documents, integration workflow. The data that is needed to make intelligent decision is often fragmented across the LOS and POS, right? AI is only as effective as the context and the data you give it. The challenge, therefore, becomes how do you create a trusted data and orchestration layer around the existing LOS without trying to replace and rip everything. That's where APIs, event-driven architecture, agentic orchestration layer, all of that becomes important, where we can allow the AI agents to interact with your existing system, gather appropriate information, trigger actions while LOS continues to remain the system of record. And then there is this other very critical requirement, governance. In credit decisioning, you need to know what data was used, what policy and model was applied, why an action was recommended, and when a human intervened. So I would summarize the challenge as three things: connecting the data, integrating without disrupting your core LOS, and then making every AI assisted decisioning explainable and auditable. If the lender solves for those three things, AI can become much more than a productivity tool. It can fundamentally change how credit moves through your entire lending life cycle. So I'm going to leave you guys with that thought. And as promised, I would love to give you all 5 minutes back on your calendar. But before I do that, I want to thank Tony and Carrie for taking time out of your busy schedule and joining Tavant on this webinar. And thank you to our audience for taking time out of your busy schedule and joining us to listen to us and learn all about how we are thinking about credit modernization. So thank you, everyone. And I hope you all have a fantastic day and a week ahead.
Thank you, Sunita, and thank you, everybody.
Thank you very much.
Thank you.
Pleasure to be here.